The housing market has flipped. Banks are getting into trouble. And today I have the pleasure of having Scott Walters, who's been on the channel before. Scott, welcome back to the channel. Thank you so much for coming on. How are you doing today, brother?
Oh man, I'm really good, Luke. Thanks for having me on. Hello to everybody watching today.
Thank you so much for coming back. Scott has been an amazing guest on the channel. Scott is an active realtor in Southern California, and he's been talking about the housing market and how it's built on essentially just a load of FOMO since 2021. And today I thought it would be a really good talk if we could kind of just talk about what is going on, because we're having rumblings around about possibly a suckers rally here in 2023. I know, Scott, from your own experiences that you've experienced this before.
Well, yeah, I mean that's why I'm here, like you said, and I mean the realities are, you're right. I came to YouTube initially when after lockdowns, like most of us locked at home, and then when we implemented stimulus, one of the stimulus measures to stimulate the housing market was allowing realtors to become essential workers. We were deemed essential workers, so we were allowed to go sell following certain protocol. But because of that lack of inventory, we all know what happened. Explosion in demand with limited inventory because of the low interest rate environment. That's when we saw those bidding wars. And at first, I didn't think a lot of it, but then I had a moment of clarity. I think I watched maybe a YouTube video. I'm like, man, they are right. I've seen this movie before. This is probably not going to end well. And so I created a YouTube channel, and I was already used to providing a lot of social media marketing, so I was fairly comfortable to come behind the camera and start giving some real talk and warning people and letting them know, hey, I'm an agent, I'm benefiting right now, but this is exhibiting bubble behavior, and typically when bubbles take place, they've crashed. So I think maybe I'm going to get on the sidelines on this one. I'll put my customers on the sidelines if they want to get on their sidelines and earn their business later. And as a result, we all have just been very interested in economics, the markets. Housing's very polarizing because the U.S. housing market, and I know you're in Canada, and like I said, I'm in California right here, which is an episode of the Wild West. I mean, it was like a showdown at the OK Crowd, working in real estate, and then the Kool-Aid drinking, people normalizing it. And I felt like a rogue agent. I was just like, man, I don't care what you tell me, I don't care. But of course, I've been around a while, and I suffered some of the blowback from '08, and so my position always was, listen, doing the same thing over and over, expecting a different result is the definition of insanity. And when I saw people drinking the Kool-Aid, and I know, like, I almost suffered from it, like I was searching homes too. I was like, well, maybe it's herd mentality, right? When we see everybody else doing it, we start doing it. Yeah, I mean, the realities are now we're seeing that, in fact, what we predicted has in fact been the case. We're not some Johnny come lately that's now jumping on the bandwagon. And then we're going to get into a lot today. I know you have a lot you want to talk about, but I think the other thing is just the cheerleading from the industry, people that have financial gain, sugarcoating it, trying to spin it, date the rate, marry the house. That's what I hear a lot.
There's a lot to dive into today here, and I think like one of the core things that you said there is about how the industry has just kind of been the jester in the case of this housing bubble. And back in '08, there was not YouTube. Like, there wasn't all these YouTubers, but it was just community-based videos. It wasn't even owned by Google at that point. I think the one thing we saw in this bubble that kind of was different to '08 was the fact that you just had so much polarizing views on social media, and that kind of captivated a massive audience and drove the herd off the cliff. It's when you get the herd mentality, which I know you talk a lot about on your channel. When you get that herd mentality, it generally doesn't end up in a good place. You actually want to be the contrarian. You want to be on the other side to what the herd's doing. And I think we've definitely seen some things that have kind of been really, really bad come out of this, that social media can in fact be used to push these things beyond the limits of what me or you might have thought was possible.
No, I mean, you hit the nail on the head. So much to digest there. Great job on, communicating that. Yeah, that is one of the things I found myself saying a lot on the channel, is this bubble is a lot different than the last bubble in many ways, really. I mean, the artificial growth due to markets manipulation, stimulus, it was even worse than 2008. But today our digital diet is much heavier. Like you said, we did not have the platforms where we we do now. That's one of the things I do love about YouTube, is because we can get real people that we identify with communicating these messages. It's not like some major network newsroom where it's handed down from some office above. Today's bubble, contagion is a much bigger component. We are all so connected to our devices. I mean, I always say for a lot of the people that bought in the height of the bubble, they no longer own their houses. Their houses now own them, because if you can't sell your house for what you paid for it, you're stuck with that house. And I always talk about, that's why we always examine cost to carry the house and make sure it's within its rent range, just in case something ever happens to us, the economy, our income, whatever, or we just want to become a real estate investor.
And just expand on that a little bit more about the rent range, because I think that is so important. And I wanted you to talk about that today, because across Canada, like most places where you can buy a house right now, you cannot rent it out for more than you pay for it, or even what you paid for it. So just explain what you mean there when you talk about rent range.
Yeah, so most people, when they're buying houses, they'll just see how much they get approved to borrow, and then I'll get a hold of them, or a realtor, and start showing them houses based on what they've been approved to buy. Most people want to go for the top of their budget, and I don't think that's smart. I don't think that's smart. But for me, like, I always want to not only earn my customers' business with their first purchase, their second, their third, their fourth. I believe it's really important that we always, like as an agent, if I get a hold of a customer and I'm showing them houses, I'm not showing them what the property's rent range is, and rarely, if ever, do they ask unless they're an investor and have plans for that property to become a rental. But I think it's an insurance policy that people could have pulled for themselves if they were buying in this environment. Had you said, okay, Scott, I see the house, I see my estimated cost to carry, how much my payment's going to be every month. What's the property's rent range? I want to see how, just out of kicks and giggles, where would it rent for if I ever wanted to turn it into a rental? Well, if you're paying $2,000 a month for your mortgage, but the place will only rent for $1,000, you don't have any option to ever put a renter into the house. And if some emergency came up, it's nice to know you sleep better at night knowing, hey, listen, if I want to climb the property ladder, if I want to stack up investments, or if I just want to protect myself if this is really a bubble. The purchase price is less important now, because I can always put a renter in there and they can carry the payment, and I don't have to lose the asset. So there's many reasons to examine it, but I think also I find myself saying a lot is, if you want to know the true value of your house, if you own it, see how much it'll rent for. That shows us the value of neighborhoods, what the rent range is. As a real estate guy and somebody who wants to protect clients and help them, not only earn their first house, their second house, and knowing that 90% of all millionaires made their money in real estate, and because that's what I do myself, and I'd never suggest anybody do anything I'm not doing myself, that's what's allowed me the free time I have in my own life. I think today this narrative of cheerleading is, look good now, buy this FOMO factory brand new house, model home, with all these great color schemes and finishes, and look like a rich person now. And people don't want to earn it now and then look rich later. Most rich people, like Warren Buffett, you would never know they're rich when you look at them, because they don't live like this fake lifestyle. They're not concerned about that, right?
And they don't get emotionally attached either to these properties. Like, you see a lot of people who are buying based off emotions, and I always think that's a red flag when it's anything financial, because when you're emotional about something, as you say on your channel many times, when people are set on buying a house, it doesn't matter what you say or do, they're buying the house.
Yeah, it's totally true. So yeah, it's funny. Once people make up their mind to buy, they're buying. The sky could be falling. I remember in the last '08 era bubble, that was me, actually. I remember the same thing. There's some softening. Like, I know you want to talk about a suckers rally. I probably bought the suckers rally. It wasn't the top of the market anymore. It had come down, and I went ahead and jumped in. And I remember, like you said, there wasn't YouTube and other platforms warning me, but there was some blogs and chat boards that I remember people, like a couple, maybe one or two, warning, but I dismissed it, because unless you've lived through a boom and a bust cycle before, you're just going to buy. And even many people in this one that did live through the last bust cycle went out and drank the Kool-Aid. How do I know that, you ask? Because I work in real estate. I was side by side with these agents, like, dude, don't you think this is a bubble? They're like, oh no, this time is different. Okay, whatever.
Yeah, that's so totally true. And one thing I just wanted to bring it back to when you were on about rent range, because I think this is really important, is your rent range is kind of like you can just take any city. If you have to pay much more to buy that house and you can't rent it out and at least cover your costs, then you kind of know already that you're in a bubble.
Yeah, no, you're right. I mean, and I think, like you said, we can always tell the value of a neighborhood by what the rent range is. I think it's a really good tool. I think for people, even if they're not in the markets right now, but they like playing and, researching property, or they're interested in buying at some point, I always think it's just a good idea as we're looking at properties. You can check the property's rent range, and what you can do if you want to put your payment within its rent range, well, you can buy a less house, so you can put a bigger down payment, and you can just make sure you put your payment yourself within its rent range. Now, I like to examine today's interest rate with a standard amount down. Will it pencil out? Zillows will tell you that. When you're browsing properties, it shows you your estimated cost to own. And if there's data available, it's going to show you its estimated rent range. Then at the next step is really, if you don't have an agent, get one, and get a good agent, one that's been around a while, somebody that knows the area, somebody that's high level. But a lot of people don't understand. They see these websites, they clicked request tour or something, then the next thing they know, they're selling that click to an agent like me, and then I try to represent them. A lot of agents also just fall in the hands of the selling agent, and now the selling agent's double ending the deal. And I always say it's like going to court using the other side's attorney. You just don't want to do that. You want your own representation. But a lot of people, they don't know, they don't care. I'll just selling side's first fiducial duty is to their seller. That's who they're contracted with. If you happen to stumble into their lap and they're like, all right, I get to double into this deal, their commitment's more to the seller than the buyer in that situation. So much to unpackage. I mean, there's a lot, right? I mean, this is just the waters we're swimming in. This is the high-flying, cutthroat world of real estate. Now we're navigating not only a bubble, the biggest bubble ever produced in world history. Like, that should have everybody's attention. If anybody wanted to normalize it, it was me. I live in an episode of $1 Million Listing. The average home price is well over $1 million where I live here.
It, like you say, this bubble as well is the everything bubble. I mean, literally, it's not just houses. We've seen cars, we've seen collectibles, the stock market, the bond market. Everything was just going parabolic in 2021 off the stimulus that was injected countries around the world. And I find it just kind of crazy. I want to show you this chart. This is US home sales, and it's going from 2008 all the way to 2014. One thing I wanted to outline, that is not a straight line. like that is all over the place. So we are really operating in this extremely volatile market. So we are now operating in this extremely volatile market. And I think that's something really key here, because you're going to see sales go up. You may even see prices go up at some point. But you have to bring it back to the fundamentals of where this economy is heading. And it seems like economies all over the world, the US, Canada, the UK, most of Europe, are heading off a cliff right now, as we're seeing all over. I mean, how are things in Santa Barbara right now? Are they having as much trouble as places we see in Canada that are also over $1 million average home price? They can't get people in to work at restaurants. They can't get even doctors in to work at hospitals.
Yeah, it's the same exact thing. I mean, it's extremely broken, in my opinion, right now, because we're shooting at a moving target, right? So when we were in this bubble behavior headed up, then you could price up here and still be able to get people over there. But now we're even here in Santa Barbara, seeing it decline. Now a lot maybe flatlining where others are going down. So what you have to do now, if you're shooting at a moving target, selling your house, and the market's going down, where are you going to price up here? No, you got to price in front of it down here, because as an agent, I got to create urgency anytime I'm selling a property, right? It's got to be very strategic. Price, where we come on at. So the only thing that fixes it is price. So prices are going to adjust. Demand's being cooled off. Basically, what it comes down to is leadership now is ushering in on purpose a recession. It's not an accidental, unfortunate byproduct of inflation. This thing is being ushered in. This is market manipulation again, deflating it. So the only way to do it is like we gotta recess the economy. So they're ushering in this recession. Now they want to tell us that they're aiming for a soft landing, but they're also telling us they only have a blank blunt tool, interest rates, to really, can't laser target different parts. All they can do is raise rates, cool off the market, see the blowback. Needed step in. And I think everybody's hoping that they're going to step in and pivot, but it would be counterproductive because inflation now is ingrained so deep into the fabric of our economy. They can't. In order for it to actually work out its own kinks, it's going to take time. So the same thing with housing and prices is, prices in some areas are fairly resilient. There's more money in this area. It's going to prop it up a little longer. It'll just be the last to join the party. Eventually, you're going to get dragged along for the ride. And because, like we started the show, because of contagion today, it's going to play a bigger component in this one than previous ones, quite possibly. So we really need to keep our thumb on the pulse.
You talk about contagion. We just literally had in the past week, I'm not sure when this video is coming out, but it was literally on Friday, the SVB, that collapsed, 18th largest bank in the US. And now there's a lot of talk about bank runs, contagion, all kinds of things happening on the back of that. And I think an important question that people need to ask themselves right now, am I protected? Do I have my own insurance on this situation? Because this situation is getting gnarly. And me and Scott, we're friends. We talk about these things offline as well. And even we've said it to each other. We can't believe what is going on, right? It's insane.
Throw a dart at an economic challenge map, you're going to hit one. You're going to hit one, And so one of the things, like with this new development with this bank failing, big bank failing, right? And like you said, there's some people that was like had millions of dollars in that bank and they're only insured up to $250,000. But I heard, reports of one customer having 10 million in there. And so she's only going to recoup potentially $250,000. Like, that's insane. So I think for a lot of us, even prior to this bank failing, a lot of people that watch these types of shows have digest content and kind of alluding to bank failures, potentially being something that we could contend with. It happened in the Great Depression, right? And we are in the depression cycle with historical data showing us we're actually in a depression cycle, and we've created the perfect storm to deliver it. So when you see a big bank fail like that, it gets our attention. And so, like you said, because of the digital diet today, contagion could start getting people to do bank runs just out of fear. And then it's game over, the nail in the coffin of the economy, right? We're thrusted not only into a recession and depression. So this is a little, concerning on that level. Now it comes down to your exposure. How much exposure do you have into the banking system right now? If you're millions of dollars in the banking system and it's only insured up to 250 grand, well, then you're probably wanting to move money around and diversify your savings account or whatever, your cash position, to other banks. And that's kind of what I, do. And I never suggest anybody do that when I'm not doing myself. I try not to hold that much kind of money in one bank. And I have physical, I'm holding more physical at this time too, just in the event that some, I did evaporate. I want to make sure I have emergency cash, metals, whatever that could be of value in the worst case scenario. Some people are out there prepping much harder than I am, but I do have some preps because I always say failing to plan is planning to fail. You got to have some kind of plan. It could be a simple plan, $100 bill and a silver coin and a case of bottled water. If you have some kind of plan, you're going to sleep a little better than the person that has no plan at all.
Exactly. And we operate in this reserveless system now where banks, they're lending out all this money and they don't have the funds to back it up. So it can easily go wrong when you've got lots of people going out to the ATM. And as we even saw with this SVB, I don't know if you saw this, people don't even have access to their funds over this weekend. So that's why it's so important to do what Scott said, have some cash on hand always. We've always been preaching that, have a backup plan for when things head south, and hopefully they don't head south. But the way things are heading, we just see that on the horizon right now. But you mentioned about FDIC and the $250,000 insurance, and we have a thing here called CDIC, which is essentially the same thing. It doesn't cover up to that amount. It's only $100,000. But I think it's important, and you might not know this either, Scott. FDIC and CDIC, they don't have the funds. If one of these big banks goes bust, like a Citigroup, a Wells Fargo, or in Canada, Royal Bank of Canada, TD, one of these big banks goes bust, they don't have the funds to actually bail them out like they've done with this SVB. But you have to realize that they don't have the funds. So where is that money going to come from? And I think we all know where it's going to come from. It's going to come from the same place where it came from in 2020. And what could that do in a time of high inflation already that could just send things even worse? So I think you have to be aware of that as well, because they say they insure, and it's almost like they're saying it but not meaning it.
Yeah, I know. Being insured is one thing. Collecting is a completely different one, right? So yeah, I mean, that's a really good point.
I mean, I think it's kind of crazy, this environment that we're in right now. We talked like a year ago and we were saying we're going to be having an entirely different conversation to the one we were having back then. And here we are, and I'm sure next year, unfortunately, I don't think it's going to be any better the way things are heading. I actually saw a chart the other day, Scott, which was showing, because there's a lag effect of these rate hikes that everybody talks about. I'm sure you've heard about it too. The 4.5% that Fed funds is at, and the 4.5% that the Bank of Canada is at too, when you actually look at when that rate is finally going to impact the economy, you're talking Q1 of 2024. So that means even if the Fed, the Bank of Canada, they start cutting rates the end of this year, the impact of them cutting rates isn't going to come until the following year, potentially. I know a lot of people are jumping on that. You said about a pivot earlier, and there seems to be a lot of narrative around that. It's like a herd mentality starting again around this pivot. Oh, there's going to be a pivot and everything's going to be okay. And as we've discussed before, when the herd goes out and says something or does something, generally the opposite of that happens, right?
That's exactly right. I mean, first of all, there's no guarantee the rate manipulation by the Fed, pivot or otherwise, is even going to work. There's no guarantee. I think people have this false sense of security that rate hikes or rate pivots are going to actually impact anything. There's no guarantee. It's just what's worked in the past. In an inflationary war, you fight it with interest rates, but you got to raise that federal funds rate above the rate of inflation in order to have a chance to maybe see if you can tame inflation. And how it doesn't happen overnight. It could take till 2024 before we even see the results start to roll in. So it's like you're testing a theory or something that's worked in the past, but you're not even going to get the result for months, years, you know? So like you said, I think like that's a really good point. You know, when we first started talking together during the crisis, this is when we came to YouTube, and, you know, I said, I think in a year we're having a much different conversation. And that was during the height of the buying euphoria, where you're an idiot if you're on the sidelines. Get into these markets. You can't lose. We saw Wall Street drink the Kool-Aid. A lot of people saying, oh, well, aren't all the Wall Street investors going to scoop everything up if the market crashes? No, they're the ones in trouble. They're the ones that drank the Kool-Aid for the most part. So they're falling big, just like the Silicon Bank. And so, you know, they drank the Kool-Aid. That's all it is. They drank the Kool-Aid, invested in sectors they shouldn't have, and they lost their customers' money. They gambled in these markets. The stimulus era created a casino climate, right? It's very similar. It happened in 1929. Stock market crash, by the way. People were playing in the markets, and with the casino climate, you've got a lot of skills in terms of trading. You know the markets pretty well, enough to be in there professionally working at that capacity. I work in real estate. I don't play in the stock market. It's not my wheelhouse. I'll lean on you if I want to get in there for advice, and I've done it. A year from now, 2024, it's guaranteed we're having a much different conversation. And I hate to say it, I don't take any pleasure in saying it. I don't think it's rainbows and sunshine. I don't think isn't that a great miracle? We all live in utopia now and everything bounced back. It's rainbows. No, we got to pay the piper from overstimulating the biggest asset class in the world, the U.S. housing market that attracts all those foreign investors, and why it experienced bubble behavior. And people did the same thing over, expecting a different result. They let a bubble become normalized, and they've always crashed every single time. Not 1% of the time, not 2% of the time the housing market exhibits bubble behavior. Do they crash? 100% of the time. So anybody not willing to put at least a little bit of crash risk on that, I had to politely disagree. Now, you're entitled to your opinion, but we're seeing which ones are smart right now. The ones that were fearful when others were greedy. Now it's time to be greedy when others are fearful. It's better to be prepared for something and have it not happen than have something happen and not be prepared. Millions of people just aren't prepared. Why? Because they haven't saw messages like this, or they've never lived through it firsthand, or they're cheerleading these markets because they have no choice but to cheerlead these markets because they drank the Kool-Aid themselves and they have financial gain in these markets to support an artificial lifestyle they created through a boom era. We're now heading to a bust cycle, it would appear.
And I think you're totally right saying that. And you know, one thing to me which kind of stood out was like the retail involvement in the stock market, and then like you just touched on in the real estate market, was the corporate and institutional involvement in the real estate market. Like they were kind of like the opposite of each other when you had the retail involvement in the stock market and then you had the institutions in the real estate market. Warning bells should have been going off in people's heads, because that is just not the way these markets are usually operating, with that kind of casino type environment that we had. And it really was all the way back to real estate as well. And just to wrap up here, thank you so much, Scott, for coming on here to discuss all these different things. And I'm sure we're going to be coming back doing this more and more this year. I haven't done many interviews, and the first interview coming back, I wanted to have you on, brother. Thank you so much for coming on. Please check out Scott's channel. I've linked it in the description. We've done many interviews before. Scott is always giving it the real talk. He is the real deal. Is there anything that you want to say before we go here, Scott?
No, just in final thoughts. Listen, friends, it's always an honor and a privilege to be able to come talk real estate and markets and some of the things that we can expect moving forward. You know, my message has always been, and it'll always be, not only do I want to see you win in real estate, I want to see you win in life. So understanding when bubbles take place, there's a good chance they're going to have some blowback. It's now just temperature checking and seeing which areas are going to exhibit the blowback first, and then seeing if our neighborhood are resilient to that. We're going to have to help a lot of people moving forward, I'm afraid. I've lived through it before. I don't regret having gone through the last bubble, but I certainly don't want to go back and repeat the same thing over, expecting a different result. So I think it's very important this time just to understand the waters we're swimming in, navigate through them the best of our ability, hopefully be iron sharpens iron, be able to go out there and maybe capitalize on some of these markets because we played it safe, not out of greed, just out of opportunity. If that's something that we're interested in, we'll have to decide moving forward, but all we can do is stay together on it as we move forward, and I'm pretty confident we'll be just fine. So thanks, Luke, for having me on today. It's always an honor and a privilege to be with you, and especially our viewers.
Thank you so much, everyone, for watching. Thank you to Scott for coming on here, and I'm sure we will be back. If you've enjoyed this video, there are 2 videos popping on the screen right now. Check out either one of them, and I will see you all in the next video.